Welcome back, and today we'll look at dividends and a company that came into the screen. All right, first we'll start with Dividend Radar. You can go ahead and download this, and if you don't know this process, I'll put the link for the tutorial video in the description and on the screen. And once this is downloaded, you can go back to Google Sheets or Excel. And I did find an improvement in our scripts. So if you go to Extensions, App Scripts, that takes us back to Chowder. And if you scroll down to the bottom, you have your sorting criteria for if it's within fair value or within margin of safety. Before we had above in this line, and instead if you change that to fair, that'll fix the script to where you'll only get fair value stocks in this column. And the company I'm going to look at is Triton International Limited. This is an industrial company, been paying for 6 years, which means past 6 years they've had increasing dividends, currently paying a yield of 4.69, average 5-year 568, pay 4 times a year, so that's quarterly. For their growth, for a 1 year, 13%, 6.6, and 6.9. Dividend Radar would say it's in the margin of safety at 25% discount. It's got a Chowder number of 12. Good EPS on the year. Return on total capital, 5.83. PE of 5. Price to book of 1.3. PEG of 0.8. Okay, let's head back to our dashboard. Throw in TRTN. And here, this is Triton International. This company deals in renting and leasing of storage containers. And they operate in 2 segments, leasing and trading. And they mostly work in dry, refrigerated, and special tank containers. And Triton was founded in 1980. All right, the company has a market cap of $3.5 billion. Earnings $666 million with revenue of $1.8 billion. Company pays a dividend of 4.8%, payout of 25%, PE of 5, a forward of 5, and a PEG of 0.5. Price to sales 1.9, price to book 1.4, and then a lot of debt. So with these shipping companies that are in the business of leasing, they're going to need to carry a lot of debt in order to buy these containers and then lease them out to people. Good EPS. Next year, growing slightly. This year, growing a lot, but next year, retracting. But they've got EPS in the past 5 years growing by 100%, but not a lot of insider ownership. Institutions own about 68%. We could take a look at that with Wisdom, TRTN, calls to puts ratio, 2 million calls, 847,000 puts. Recently, tons of sales. Get back to our dashboard. Return on equity, 28%. Pretty good. Very nice margins. Not a huge short float. Okay, current and quick ratio, 5s. Yeah, from a valuation perspective, it looks cheap today, but this is predicated on these earnings remaining steady, which is definitely in question. Graham would say it's 65% on discount. We'll take a look at that. We're using an EPS of 10, a PE of 7, growth rate of 10% over the next 5 years, and a 1G, corporate bond of 4.4, and a AAA bond of 4.89. That gives us an intrinsic value of $155. with 65% upside. Graham would think it's cheap. He acquires multiple. Take a look at that. 3 is very low, so that is good. And you're looking at an enterprise value of $3.4 billion with a market cap of 3.5, operating earnings of $1 billion. Good. But that is if they can keep these numbers for the foreseeable future. Okay, Petrosky of 7. That's good. Take a look at that too. Okay, ROA, positive net income, and cash flow is greater than net income. Get 1s there. We lose 1 on our current ratio. So we have a worse ratio this year than last year. Shares remain the same. Gross margin is up. And asset turnover is the same as last year. So we get a 7. Okay, back to the dashboard. 10 cap rate of 79. That's really good. Very low CapEx and high cash flow from operations. Earnings yield, very nice. EV to operating cash flow, very low. That's good. EV to sales, good. All right, let's take a look at the company's website. So again, shipping container company, go to the investor page. Take a look at this presentation from the last quarter. You have to take these with a grain of salt because companies go out of their way to make all of these reports look as good as humanly possible. But net income of $186 million, up only 5% from Q1. Annualized return on equity, 29%. We saw that. And gain on sales boosted by 6.8. So they had gains over the past year. The question is if they're able to sustain that into next year. Let's head over to Open Insider. TRTN selling across the board. So this is not great for us if we were looking to buy it. All right, we'll take a look at the technicals. On the top, you have the weekly chart. On the bottom, you have the daily. Currently with a relative strength of 83. And this is like IBD's, Investors Business Daily relative strength. But it's currently below the 30-week MA. Looks like it had a nice long stage 1 base all out here, moving into stage 2, and it really looks to be topping and kind of falling over at this time. Same thing with the daily below, big gap down and below the 30-day MA. You also have the MACD flipping and turning downward. So that is a bearish sign. All right, well, Triton, the company's interesting. I think we're going to have a lot of turmoil in the next couple months with US interest rates rising. This is not a great time to be buying, but they are a dividend company. I would keep this in a watch list and keep an eye on it because they do pay a nice dividend. They can continue to pay it off. They're well run, well managed, and this might be a good long-term company that you can accumulate on the value side and pick up those dividends while it is relatively cheap. All right, that's all I have for today. We'll see you soon. Thanks. Bye.